Markets at the moment are dominated by headlines around Russia and Ukraine. Now, of course, any kind of conflict can come with a terrible humanitarian cost, so let's hope that can be avoided. But by looking at precedents from the past, we can gauge what could happen to markets if this does escalate, but also which markets could be affected and what the transmission mechanism could be for those markets to be impacted. So let's look at the Russia-Ukraine conflict in a bit more detail. The Russian equity market peaked in October of 2021, and if we track single country exchange traded funds since then, you can see that it's the country which has fallen the most. Russian equity is down by around 30% as I make this video. But that's certainly not true of all countries. For example, you can see that 3 of the countries I've shown here actually rallied. So that's South Africa, Taiwan, and the UK. But if this conflict does escalate into a full-out war, then we would expect volatility would spill out further into broader equity markets. I think it's helpful to look at some historical conflicts to see how they affected markets in the past. And some journalists from Bloomberg picked up on this table, which was published by Keith Lerner at Truist. Now, what this does is to track the S&P 500 for 1 month, 3 months, 6 months, and 12 months after a given military event. So it starts with Pearl Harbor in 1941 and it goes through to the Iraq War in 2003. But what's truly remarkable is that if you look at the average response to those events, they're generally positive. In fact, only 3 of those events still had a negative effect on markets after a 12-month period. Those are the ones which are highlighted in grey here. So that's the Suez Canal crisis, the Arab oil embargo in '73, and 9/11. So what is it about those events which meant that they were longer lasting than the rest? Well, I think it's helpful to decompose the response to these events into a fast component and a slow component. The fast component is illustrated nicely with the example of Pearl Harbor. So here you can see the equity market fell in response to that shock, but it only fell for about 3 months and then very rapidly recovered. Now that's the fall in risk appetite, which tends to be fairly short-lived, which is a response to these scary headlines. The thing about fear is that if it doesn't continually get fed by new headlines, eventually it dissipates. The Arab oil embargo also starts with an initial shock, which caused markets to fall very sharply, and following that there was a slight recovery, but then there was a secondary effect, and that was a very negative effect on the US economy due to the higher oil prices that followed that embargo. Now that made inflation spike, and it had very long-lasting effects, negative effects on the US economy. So whenever you see one of these conflicts, you've got to think about that slow response, because that's what's really going to impact your portfolio. Will it cause lasting economic damage? Now let's look at all of these events on one timeline for the S&P 500. Now this is a log plot because if it wasn't, it would just spike up hugely because it's geometric growth. But what's really interesting is that many of these events almost have an invisible effect on the S&P 500. What really dominates is that long-term trend growth, which looks linear on this plot. The S&P gradually grows regardless of all these disasters which occurred during this period. The events with names in red, such as Suez Canal, Arab oil embargo, and 9/11, are the ones which were more long-lasting. They lasted at least a year in their impact on the S&P. Now, as we've already seen, those are more long-lasting because of their economic impact. These are events which had a bigger economic impact. And in order to gauge that, there's something else we have to look at. And that's the profit generated by the companies in the S&P 500. So here are those profits, again on a log plot because they increase geometrically, and what you may be able to see is that the more long-lasting crises are the ones which had the biggest impact on profits. So for example, after the Suez Canal crisis, earnings on the S&P 500 were falling for some years, and after the Arab oil embargo, earnings were essentially flat for almost a decade. So really, when you look at the impact on the US equity market, you should always be thinking, does it affect the earnings? If the answer is no, then it probably won't have a long-lasting impact. The impact will be short-lived, and it'll just be that rapid response which recovers very quickly, because a reduction in risk appetite is not something which is long-lasting. The transmission mechanism between these conflicts and market prices in equity was usually via the price of oil. That's illustrated very clearly with the Arab oil embargo in 1973, where if you look at the price of crude leading up to that crisis, it was very stable. But literally overnight, the price of oil spiked. The reason why was that political instability in the region was going to threaten the supply of oil. And because demand for oil remained high, that would push up oil prices. And that's been true of many of these conflicts since then. For example, when Iraq invaded Kuwait and the Iraq War. But if you look at petroleum consumption and imports in the US, you can see why it was very exposed at the time. The blue line at the top of the graph is US petroleum consumption. The brown line beneath it shows you domestic petroleum production. And any difference between the two had to be plugged by imports. Many of those were from the Middle East. So if there was a disruption to supply, the US didn't have any choices in how it could meet its oil demand. And if you contrast that with the present day, the situation's very different. Since the mid-2000s, you can see the production of petroleum products has increased hugely, and that's because of shale oil. And consequently, the net imports required to meet demand have fallen very dramatically. In fact, if you look at the net trade in petroleum products, you can see that that crossed over the point of zero when there were more exports than imports at around 2010. For crude oil, the US still imports more than it exports, but you can see that that's also getting closer to zero. So while it still is the case that a spike in oil would be inflationary in the US, at least for a large sector in the US, which is the energy producing companies, a higher price of oil will actually be a positive for those companies. This story about Russia and Ukraine was one I covered recently in the weekly market roundup. This is something I write every Friday. It comes straight to your inbox, it's free, and it's a great way to learn more about investing. If you want to learn more about it, then just click on the link beside me or in the description beneath me. If this conflict is going to create disruptions, it pays to look what Russia's exporting and where those exports are going. So in this left-hand panel, you can see its exports in 2019 broken down by product. And the vast majority of them were energy products. So that's crude petroleum, refined petroleum, but also coal products. They also exported many industrial metals, such as iron, aluminium, copper, but also nickel, and also some precious metals, such as gold and platinum. And if we look at the export destinations by country, here in the right-hand panel, the pink region is Europe, and that dominated their exports. So if there is a disruption, it'll be primarily Europe which is affected. But the red panel to the right here is Asia, and those countries would also be affected. If we look at Russia's share of total world oil production in 2020, you can see that it made up 11% of supply. So this is certainly a major player, and a disruption there would have big consequences on prices globally. From a strategic point of view, Russia's natural gas exports are probably even more important than their oil exports. That's because they make up over 40% of the imports of natural gas in the EU. That's why they've created the Nord Stream 2 pipeline alongside the Nord Stream 1 pipeline along the bottom of the Baltic, and that sidesteps Ukraine. So this could increase the supply of natural gas from Russia to Europe. Now, the US isn't too keen on that because it supplies liquefied natural gas and it sees Russia as a competitor in servicing that demand from Europe. In fact, in 2019, it branded its liquefied natural gas as freedom gas. Of course, that was the butt of many jokes at the time, but the point is that they wanted to create a strategic alternative created by an ally of Europe rather than a potential adversary. In contrast, the UK is much less heavily dependent on Russian natural gas. In 2020, it only made up about 5% of the UK supply. The vast majority came from Norway, and about a fifth of the UK supply came from Qatar, although the US's freedom gas did make up about 11% of the supply. So if the Russian supply cut out, certainly from the point of view of the UK, we could probably fill the gap. Another transmission mechanism to markets would be indirect, and it would be via the sanctions imposed against Russia. Now, of course, the idea behind sanctions is that it makes it too expensive to even contemplate the prospect of war. But of course, that comes at a cost not just to Russia, but also its trading partners. So one of the suggestions from the US was that they ban Russia from using the SWIFT network. Now, this is like Gmail, but for the payment system between banks. And they didn't really think this through because many European banks have lent money to Russian companies and wouldn't be able to receive payments if they were locked out of SWIFT. And that's what the chair of the Financial Stability Board is saying in this article from the FT. Basically, don't do it. Don't switch Russia off from the SWIFT network. So here are 5 European banks which have such exposure. These are banks which have lent money to Russian companies and which would want their money back. And if the SWIFT network was switched off, they presumably couldn't receive those payments. But what's also worrying is that these banks would form a transmission mechanism from Russia to European banks, and that in turn could create a problem for the European economy. Fortunately, the number of banks is fairly small, although the ECB has asked all banks in the euro area to declare exactly what exposures they have, so there might be some surprises in store there. But the latest iteration of sanctions is more targeted. It focuses on individuals, mostly oligarchs, but also the main banks in Russia. So that would be Sberbank, VTB, and Gazprombank, for example. So by limiting the ability of these banks and people to do business in the West, that would effectively be a very high cost for Russia to enter this conflict. Russia also produces some very specialized metal exports. So for example, it produces 35% of the global supply for palladium, and palladium is used in catalytic converters in cars. It also produces 9% of the platinum supply globally, and again, that's used in catalytic converters. So if these supplies were to be cut, that would have an upward price pressure on things like cars. And that's one sector where we've seen high inflation in developed markets. And that's probably not a cost that politicians would be willing to pay. In summary then, I think the direct effect on US earnings, but also earnings in other developed markets, will be fairly negligible. However, the indirect effect via inflation could be significant. That's because Russian exports are at the core of this inflationary spike that we've seen recently. That came from energy products, remember, but also used cars and trucks. And if catalytic converters go up in price, that would affect the price of new cars. And that could make the inflation situation even worse. And I'm not sure that's a price that politicians would be very happy to pay or that markets would be very comfortable with. So that could cause equity markets to derate because it could cause inflation to stay higher for longer. Now remember our offer about the weekly market roundup. You can learn more about that from the link in the description. And as always, thank you for listening.